Hi guys, and welcome to a brief screencast to help explain some of the concepts in week 2, which is quite a complex exercise. What I've done here is put together a more simple scenario. So for those of you struggling, if you look at this first and the accompanying slides, then hopefully this will give you a solid foundation. So I've got a business that's got 4 simple events. It's going to sell something that it's bought, and it's going to have some overheads in running that business of some IT equipment and an office and some rent. All the transactions are invoiced and they're on 30-day terms, and so essentially we're going to describe this without any transactions for cash, because none of the cash transactions have yet happened. So 2 things: how would you explain how the business is doing? A, using some business common sense, and B, actually looking at the entries in an accounting system. If we look at the 2 of those together, then hopefully you get a solid foundation in terms of how the 2 differ. So firstly, using business common sense. What is business common sense? And also what you'll find in trying to describe that business, you need some common language or a framework. Otherwise, 2 things happen. 1, the common language is cash, and in this example, no cash has changed hands. Or 2, you don't know how to describe it to somebody else because they don't know the language and the common terminology you're using. So what can common sense tell us? And then let's look at the framework in which we're going to try and put that together. So we bought 10,000 bars for £1. We sold 3,000 of them for £2.50. So we sold them for more than they cost us. That's a good start. And we've got 7,000 of the 10,000 left. In accounting terms, we'd call that stock. But we still need that language to record that. And that language you're going to use is the trading language of the profit and loss. So we're going to have sales, we're going to have cost of sales, and also we're going to describe how we treat the costs or the overheads in making these sales. So this piece here is the fundamental element of what we're looking at in accounting. And in practice, we'd record those in an account system so we can then analyze and report the results. Now, we tend to do that in a period of 1 month for an account system, although we can report daily, weekly trends for management purposes that aren't necessarily in the account system and really are just around, well, how much are we selling? Are we making any money on what we're selling? How does it compare to last month? How does it compare to the budget? How does it compare to the trend? Now, that to me is the common sense of the financials, and you don't need to know anything about an accounting system for that. You just need to understand, numbers. Okay, so this language and framework, let's introduce it at its most simplest level. A trading business sells something and has costs in making those sales. You might see several names for this: a trading account, profit and loss account, an income and expenditure account. Each business will call it something different, but at its most simple level, we're going to have sales, we're going to have cost of sales. The difference between those I've called gross margin. I prefer the margin terminology here rather than profit because we know we're at this level. Profit comes down further on. And then we're going to have these overheads, the laptop, the printer, the office, and we're going to come to a net profit. Now, more complex, we can have tax, we can have interest, we have varying levels of profit. This most simplest level, this is what we're looking at. So all of this within the state of, let's describe 1 month. So still using business common sense, we've now come with this framework: sales, cost of sales, gross margin, overheads, and net profit, and we've come up with a period of 1 month. So let's go through each one of these 4 transactions in terms of what the description is, how we're going to do the workings in terms of common sense, and what the answer is going to be for this 1 month period. So quite simply, we sold 3,000 at £2. Let me change this on the hoof. We sold them at £2.50. My apologies. 3,000 times £2.50, 7,500 sales, 7,500. Now we've got our cost of sales. Even for the accounting trained amongst us, the question sometimes is around, we've got 10,000, but what we're trying to do here is we're trying to describe what's happened to the 3,000 that we sold. So we're going to take those 3,000 at the pound we bought them at, and as it says on the tin, this is the cost of what we sold, quite simply 3,000. Take one from the other, and we've got a gross margin of 4,500. So those of you who are more inquisitive will be sitting there and saying, well, what about the 7,000 bars? That's where we need our accounting system. In the common sense framework here, we're going to ignore that, put it to one side, and say what we're doing is describing the trading of the 3,000 bars. So we do get into a little bit more accounting terminology here, because we're looking at this for 1 month, and this laptop and printer is certainly going to last us for more than 1 month. And this is where we have the concept of matching over its useful life, and that's the term depreciation. So quite simply, all we've done is to say, okay, I bought something for 1,200. I think it's got about 2 years in terms of before I replace it. So I'm just going to spread that 1,200 over 24 months, which is going to give me £50 a month, and I'm going to call that depreciation. Likewise, my rent, £6,000 for the year. I'm going to pay it quarterly, but I'm trying to describe it for 1 month. So 1 month of the 6,000 is £500. And the terminology here is an accrual because it's not yet been invoiced. And so I've just got to make up the entry and say, well, I know that invoice is going to come. It's going to come for the quarter, but I'm trying to describe a month. So I take those, £4,500 of gross margin, take off my £50, take off my £500, and I'm going to say I've got a net profit of £3,950. That is me in common sense. Yep, there's a little bit of framework here in terms of terminology, but it's the common sense. I've bought something, it's cost me something to sell it, and I've got some costs to run the business. So this is the trading account, and very importantly here, we're using this matching principle to match the sales and the costs for the same period. And of course, we know that it isn't able to fully describe all the transactions and the stock. If you ignore my typos, I can spell, I just can't type. So that's the summary in terms of our business common sense. Let's leave it on the right hand side here so we can see it as we travel. Hopefully what's in Word here matches what we've got in the PowerPoint presentation. So yeah, I've got my sales of 7,500. I've got my net profit of 3,950. So what I'm going to do now then is come on to my accounting system. So to get all this in my accounting system, I'm going to have the awfully named double entry. Now, there's not an expectation for you guys on an MBA to actually understand the double entry. Those of you who train as accountants will know it takes you several weeks, if not months, laboriously understanding that. I'd liken it to a car. You don't need to understand how an internal combustion engine works, but you do need to know, where do I fill it up with oil? You know, where do I turn it on and what does it look like? So we're going to show you here the entries that we would make in an accounting system, all the entries. We're going to introduce the nominal ledger as the accounting system, and this is where the entries take place. And this is also going to show the actual entries that would happen, but hopefully explained in a common sense way. So we're not going to talk debits and credits, but we do have these two sides of entries. And again, this is just purely to illustrate the concept. Will include the accruals and the depreciation. You're not expected to know how to make double entry. You're just expected to understand the concept, and hopefully by seeing the concept in practice, it will help you interpret the results and understand the results. I've got a separate Excel glossary that actually puts some of these terms and shows how they interrelate in a simple Excel file that hopefully may be useful to you guys to take away and use outside of the MBA. So I'll share that as well. So these accounting entries, by the way, are called a trial balance. You'll probably never see a trial balance in practice, because what comes out the other end is the trading statements in terms of profit and loss and balance sheet, which is what you'll be familiar with in a business. So in this nominal ledger, sorry, ignore this 10, this is the page number come through. In this nominal ledger, we're going to have some codes, because when the accountants are making these entries, they've got to have some codes rather than some descriptions. These are actual codes in a Sage system for a small business in the UK. So anybody who's got relatives, friends, or has done anything in Sage might actually recognize these codes. So we're just going to go through these 4 entries that we've got here in terms of selling, buying, and having the depreciation and accrual. So first of all, we've made a sale. In making the sale, don't worry too much about the double entry in terms of which one's positive, which one's negative. Just know that the two sides of making a sale is somebody's going to owe you some money. This is called debtors in accounting terms, or American terminology does what it says on the tin. It's a receivable that you're going to receive. So the other side is you're going to record some sales. Same principle. You got an invoice for the stock that you've bought. You're going to owe somebody 10,000, so it's the opposite of what somebody owes you. Accounting terminology, it's a creditor, or more simply, it's a payable. Now, that £10,000 we're going to put into stock. The reason we're going to do that is because we haven't sold it yet. So in our trading account, because we haven't sold it, we don't want to record anything around the sale. But what we are going to do is we're going to make an entry to reflect the 3,000 units that we've sold. And again, even for accounting people, sometimes this is the entry we forget. These entries are coming through on invoices, so they're actually being made by somebody processing the bits of paper. This entry is either going to be made automatically by the account system, or somebody's going to come in and do that manually. And that's the £3,000 that we saw here in terms of the cost of sales. So hopefully you can start to match the £7,500 sold, the £3,000 in cost of sales. But in that common sense entry, we didn't account for the 10,000 chocolate bars because we're just interested in the 3,000 that we'd sold. Following on the final transaction that we've actually got an invoice for, we've bought a computer for £1,200. Similarly, in terms of the common sense, we're saying it's got a life of more than 1 month, so we're not going to have it in trading. We're going to put it into what we've called fixed assets. Here, this is current assets because we're in the business of buying chocolate bars and selling them. Here, we're not in the business of buying computers and selling them. We've just got a computer for the purpose of running our business. So we're going to owe £1,200, the same as we owe £10,000 for the stock. And then what we're going to do is we're going to make this accounting journal entry for the depreciation. As we saw over here, we're saying 2 years is its life. 1,200 divided by 24 months, or 2 years, is £50 a month. That's going to depreciate and come off our asset each month, such that 2 years later, our asset will still be there. It'll have had a cost of 1,200, we'll have had depreciation of 1,200, and our book value will be 0. It's still got a value to the business, potentially, but its book value and how we're recording it is going to go to 0. And the depreciation will have flowed through our trading accounts. And likewise, the final one is because we don't have an invoice for this rent, somebody is an accountant or somebody else is going to have to make an entry if we want to get that trading account to accrue that £500 and manage that in the balance sheet, which is this part here. We don't owe it to anyone at the moment. We're just accruing the liability such that when they raise the invoice and say, hey, you owe us for the quarter, it's £1,500, we'll have that all accrued. Interesting thing you note here, each of these entries, double entry, equal and opposite. So every entry that's made into the system balances, and that's why it's called a trial balance. So you look at the totals and just make a note in terms of what these totals are here, because what we're going to do is we're going to take this trial balance to the next page. So 7.5, 3, 550. And this is the total that we've got. So we made sort of 3 transactions and 3 accounting entries, if you see on the previous page, totaling 2, 4, 6 entries. We could have made 6,000 entries. The principles are the same. It's about understanding what comes out the other end. And quite honestly, a lot of an accounting person, when you've got complex transactions, is either interpreting what comes out or actually making sure that it makes sense and these transactions have been recorded correctly. Because accounting is still an archaic process, is that if you put it in the wrong place, you're going to record it in the wrong place, and you're going to have results that don't make sense. So this is where it all comes together. We've got this trial balance that none of you other than accountants will probably ever see. But then neatly, what happens is, for the month, we put that into a trading account. So sales of 7.5, cost of sales of 3, overheads of 550, which was the rent and our depreciation on our computer, and lo and behold, we've got the net profit, which we came up with earlier. But what is really important in terms of the entire concept is The other side of the trial balance becomes the balance sheet. And the balance sheet structure in terms of assets, fixed assets, current assets, stock, debtors, cash, current liabilities and accruals, coming down to our net assets, our balance sheet balances. Why does our balance sheet balance? Well, it's come from a trial balance that balances. How does it balance when the P&L doesn't necessarily balance? Well, quite simply, the profit that we're making in our profit account is coming down into our balance sheet to balance the two. This is a very simple example, but you can see already that we've got some complexity around the numbers that come out. But because you guys can go back and trace the entries, you can sit there and say, right, I know that stock is £7,000 because I bought 10,000 units at £1. I sold 3,000 units at the £1, and therefore I've got 7 left. You know that the fixed asset is the £1,200 we bought less the £50 depreciation. You know, the receivables is essentially at this stage just the sales we've made. The creditors, the stock we bought at 10,000 plus the computer at 1,200, and the accruals being 1 month's worth of rent. What you'll find when you run a P&L and a balance sheet for more than a year, the profit gets reset and comes into the brought forward figure for the year, continues to add up. So that is the concept of profit and loss and balance sheet. And the really important thing to note is it all comes from the accounting entries in a trial balance, which spits out a profit account for the month, a balance sheet which will be a position at the end of the month. But no, there is no cash flow. Cash flow is purely the movement in terms of cash. Oops. And at the moment, we're saying that we're on terms for 30 days. We're just describing that month, and we haven't transacted any cash. So quite simply, our cash flow is 0. Now, if somebody could invent integrated accounts that actually reported the cash flow as well, they would probably be a very rich person, because accountants spent a lot of time translating these figures and actually putting them into cash. You know, cash is ultimately what is in the bank account, but in terms of the trading and describing the trading, you've got to make a profit first to then convert into cash. So hopefully that introduction and having that step through both in the screencast and the PowerPoint will be something that you can go back, look at. Please ask any questions if you've got any. I'm sure you will have, and I think this can be a solid foundation for you guys to take away. The presentation that I'm going to share with you has got a few slides at the start. If I just take you back to these very briefly, if anybody wants to look at them, it really gives you an overview of what I think is quite critical. So we're looking at accounting, slide 2. We started at slide 5 because that's where I wanted to lead you from, but these are interesting in the context. So process of summarizing, analyzing, and reporting. That's exactly what we've just shown you how to do. But what's important is week 1, you very much looked at here in terms of financial accounting, statutory reports and accounts, annual accounting. Underneath that, you've got quarterly, monthly compliance. PAYE in the UK is pay as you earn. It's a tax on employment. VAT across the European would be the same as sales tax in the US, value added tax, and any other government statistical reporting. So this is the compliance side that you have to do. It's only on an annually, quarterly, monthly basis. But what's more important for you guys on a day-to-day basis is management accounting. What we've looked at here is the traditional management accounts of profit and loss, balance sheet, and cash flow, although we've noted we haven't actually looked at cash flow. Then, where I think the value really is in terms of a solid financial understanding is actually in the trend information that may or may not come directly from here, but is what the business is doing on a trading basis. So you're going to use this for decision making, you're going to use it in terms of key performance indicators. And if we go back and say, well, what have we been looking at? We've been looking at this nominal ledger, this double entry, which is this trial balance, and that kicks out the 3 key financial reports: profit and loss, balance sheet, and cash flow. And in a pictorial way, essentially what we have is this black box of nominal ledger, which kicks out this trial balance. It then kicks out the 3 trading statements, profit and loss and balance sheet, or in this case, it doesn't actually produce the cash flow, but the cash flow is produced from the differences between profit and loss and balance sheet. But importantly, what we've been looking at is how do these entries get in here? So they get in here from sales invoices and purchase invoices that we transacted, and also bank payments, but we didn't go that far in terms of any of those. And then you have these journal entries, whether it's people being paid on payroll, whether it's depreciation from assets, whether it's accruals or prepayments or any other kind of adjustments where entries have gone in incorrectly. So all these entries are going to go into this black box, the nominal ledger. They're going to kick out a trial balance, which is going to balance because each of these entries is going to have two sides. And then from this, we're going to report profit and loss and balance sheet. We're going to look at the difference between the two, and that's how we're going to get cash flow. So that really is the pictorial overview of what we then went in to the exercise on slide 5 to look at. So I'll share these slides with you, and you can take them through at your leisure. If I also share the Word document with the example, then you can come back and look at this at another time as well. So thanks very much. I hope that's been useful for you, and I look forward to